Ever wondered how some investors achieve massive returns while others barely break even? The secret lies in mastering the art of compounding. We all know how to invest, but what beginners often miss is understanding how to multiply or compound their investments. Let your money work for you. In this video, I will show you 6 strategies, each with a unique way of adding to your investment. One strategy has the potential to increase your investment value by $800,000, while another can add over $1 million. And one strategy boosts your dividends from hundreds to around $30,000. In the end, I will show you a projection combining all the strategies, resulting in adding over $3 million to your investment while paying over $8,000 in monthly dividends. Stick around to find out. But first, let's understand what compounding is. In simple words, it is the process of generating earnings on an asset's reinvested earnings. It's often described as the snowball effect in finance, where small gains today lead to exponential growth tomorrow. The power of compounding cannot be overstated. It's a fundamental principle that underlies most successful investment strategies. To understand how compounding works, let's look at some examples. Warren Buffett's fortune is a classic case of the power of compounding. Starting with small investments, Buffett reinvested his earnings consistently, allowing his wealth to grow exponentially over time. This principle isn't just for billionaires, though. Everyday investors can also grow their savings significantly by leveraging the power of compounding. For instance, if you invest $10,000 in a fund that grows at an average annual rate of 7%, in 30 years, your investment would grow to over $76,000. The key is to start early and let your money work for you over time. Now, to put my strategy into perspective, we need a benchmark. The S&P 500, a standard index fund, has historically returned about 7 to 10% annually over the past 30 years. Assuming an average annual return of 8%, a $10,000 investment in an S&P 500 index fund today could grow to approximately $100,000 in 30 years. This standard bar will help us evaluate whether the strategies I'm about to discuss can outperform a simple index fund over the long term. Invest in companies with a clear return of capital strategy. One effective way to compound your portfolio quickly is by investing in companies that have a clear return of capital strategy. These companies use their cash flows to buy back shares, thereby increasing the value of each remaining share. Share buybacks reduce the number of shares outstanding, effectively giving you a larger piece of the company's profits without additional investment on your part. For example, Apple has significantly increased shareholder value through consistent and aggressive buybacks. Over the past decade, Apple has reduced its shares outstanding by more than 25%. This reduction means each share now represents a larger portion of the company's earnings and assets. This strategy has helped Apple consistently outperform the broader market, but that alone won't help. You also need to make sure that the company reinvests their cash flows at high ROCE. The next strategy to accelerate the compounding of your portfolio is to invest in companies that reinvest their cash flows at a high return on capital employed. ROCE measures a company's profitability and efficiency in using its capital. Companies with high ROCE generate more profit from each dollar invested, making them excellent candidates for reinvestment. Take Home Depot's as an example. HD consistently generates high returns on capital employed, averaging around 40 to 45% over the last decade. This means every dollar HD reinvests back into the business generates substantial returns, fueling further growth. Companies like Home Depot, which reinvest their earnings at a high rate of return, create a powerful compounding effect. To illustrate the potential impact, if a company has an average annual growth rate of 8%, if it reinvests its cash flows at a high ROCE, it could increase its annual growth rate up to 9%. Over 30 years, this combined strategy could grow your investment to approximately $132,000. Significantly outperforming the S&P 500 benchmark. And this can be seen from Home Depot's average share price appreciation, which stands at 16.20% appreciation every year. At this rate, it can reach the $100K valuation in half the time of the S&P 500. And for the long term, in 30 years, the stock's high share price appreciation, thanks to high ROCE, has the potential to take it to over $904,000 valuation, beating the S&P 500 by a huge margin. High ROCE companies not only provide better returns, but also show strong business fundamentals. These companies efficiently use their capital to generate profits, often indicating a sustainable competitive advantage. For instance, HD's efficient supply chain management and strong membership models are key factors in its high ROCE. This efficiency allows the company to reinvest its profits into expanding its business, opening new stores, and improving its services. Another benefit of investing in high ROCE companies is their resilience during economic downturns. Because these companies are efficient in generating profits, they are often better positioned to weather economic challenges compared to their lower ROCE counterparts. This resilience ensures your investment continues to grow even during tough economic times. But the growth in investment isn't limited to appreciation alone. There's no point in having millions if you can't spend them. A good investment is one that also provides regular income. That's where my third strategy comes in. Invest in companies that pay dividends. Investing in companies that pay dividends is another powerful strategy to compound your portfolio. Dividends are portions of a company's earnings distributed to shareholders. Companies that regularly pay dividends typically have stable cash flows and strong financial health, making them reliable investments. When you invest in dividend-paying companies, you receive regular income in the form of dividend payments. Let's go with the same HD example. The company, along with its stable stock appreciation, also pays a 2.5% dividend yield each year. With this yield, you can see from the future projections that the investment is still valued at over $904,000, but it also pays regular dividends, even if the dividend payments are in the low hundreds. Because of low yield, it is completely fine. In the coming chapter, I will show you how even a low yield can generate high dividends. One of the most common beginner mistakes is what I call chasing high yields. Investing in stocks that pay high dividends might seem tempting because of the potential for big payouts, but just going after these without checking deeper can lead to big financial troubles. When a stock's price falls a lot but the dividend stays the same, it often means the company could be in trouble. It could be running into financial difficulties, might reduce its dividends soon, or might not have good chances for growth. So a high dividend yield doesn't always mean a stock is a good buy. So what should you do to get paid a good income? That's where my next strategy comes in. That is, focus on dividend growth companies. Dividend growth companies are those that not only pay dividends consistently, but also increase their dividend payouts over time. This strategy offers a dual benefit: a steady income stream and the potential for capital appreciation. More on that later. And that's the reason why I've chosen Home Depot as an example. This stock has been increasing their dividends for 14 years straight. On average, the stock has a dividend growth rate of 17.57%. If this factor is taken into account, you can see from the calculator sheet that the investment is still valued at over $904,000. But instead of the dividends in hundreds, they increase over time, and by 30 years, it has the potential to pay over $28,000 in annual dividends. Dividend growth companies also provide a measure of stability and downside protection during market volatility. Companies that can consistently increase dividends often have strong business models and resilient cash flows. Moreover, focusing on dividend growth companies encourages a long-term investment perspective. This commitment to returning value to shareholders can result in better overall corporate performance and enhanced shareholder value. But why stop there? Let's make it even better with our next strategy, the DRIP strategy, also known as the Dividend Reinvestment Plan. This is one of the most powerful strategies to compound your portfolio. Here's how it goes. When you invest dividends, you use cash payouts from dividends to purchase additional shares of the same stock without any additional cost. This process allows you to acquire more shares over time, increasing your ownership in the company and enhancing the compounding effect. For instance, if you own shares in a company like Home Depot, which has a history of paying consistent dividends, you can enroll in their DRIP program or do it manually if you wish. Instead of receiving cash dividends, you would automatically purchase additional shares. Over time, these additional shares generate their own dividends, which are then reinvested to buy even more shares. This cycle continues, exponentially growing your investment. Using our example of HD's future projections, you can see that reinvesting dividends not only increases your yearly dividends to over $60,000, translating to a monthly income of over $5,000, but it also adds value to your portfolio. This increase from $904,000 to over $1.9 million occurs because of reinvestment. You can buy more shares that pay more dividends, and this cycle continues. This is what we call a snowball effect in financial terms. In the end, I will show you the combined effect of all the strategies, which has the potential to surpass a $4 million valuation and pay over $90,000 in annual dividends. The DRIP strategy also promotes a disciplined investment approach. By automatically reinvesting dividends, you continuously invest in the market, regardless of its current state. This consistent investment helps mitigate the impact of market volatility and takes advantage of dollar cost averaging. Over time, buying more shares at different price points can lower your average cost per share and enhance long-term returns. Many companies and brokerage firms offer DRIP programs with no fees or commissions, allowing you to purchase additional shares without incurring extra costs. This fee-free reinvestment further boosts your returns. And now, finally, our last but not the least strategy to significantly compound your return is regular contributions. Regular contributions to your investment portfolio are a crucial strategy for compounding your wealth over time. By consistently adding funds to your investments, you can take advantage of dollar cost averaging and continuously increase your investment capital, which enhances the compounding effect. It doesn't have to be much. In fact, a $25 weekly contribution can make a significant difference. Let's apply this strategy to investing in HD or Home Depot. If you invest $25 each week, that totals to about $1,200 a year. When combined with the previous strategies, here's how it pans out. In the first year, your investment is projected to reach $13,070. After 10 years, the same investment could grow to $85,803. But the real compounding effect kicks in after that. By year 20, your investment has the potential to reach over $528,984. Given another 10 years, and in 30 years, your initial investment has the potential to grow over $3,222,942, paying $99,667 in dividends annually, which translates to about $8,306 every month. In total, these strategies have the potential to add $3,176,942 to your investment, including $2,615,284 from the growth of the stock and $561,658 from dividends. This shows how all the strategies combined, even with a modest amount, can lead to substantial growth over the long term, especially when combined with reinvesting dividends and allowing the power of compounding to work for you. Want to know how to cross 10 million with the same strategy? Click the video on the screen to find out.